Personal lines exam cost. Welcome to the quiz. Explain the purpose of an accidental death and dismemberment, AD&D, rider on a life insurance policy. Is it A, it pays an additional benefit if the insured dies from an illness? Or B, it provides a living benefit if the insured is diagnosed with a terminal illness? C, it pays a specified benefit for death or specific injuries resulting directly from an accident? Or D, it converts a term policy to a permanent one without evidence of insurability? The answer is C. An AD&D rider pays an additional benefit usually equal to or a multiple of the base death benefit if the insured dies or suffers specific dismemberment losses like loss of limbs or sight directly from a covered accident. Death from illness is base coverage. Living benefits are accelerated death benefits. Conversion is a separate option. Because AD&D provides extra payout for accidental death or injury, this is its purpose. Next question. The combined single limit in a personal auto policy applies to which coverages? Is it A, collision and comprehensive? Or B, bodily injury and property damage liability? C, medical payments and uninsured motorist? Or D, towing and rental reimbursement? The answer is B. Combined single limit, CSL, applies to liability coverage and provides one overall limit that covers both bodily injury and property damage liability arising from a single accident. Collision and comprehensive are physical damage coverages. MedPay and are separate no-fault or uninsured coverages. Towing and rental are optional add-ons. Because CSL combines BI and PD liability into one limit, this is where it applies. Next question. Identify the term for a person who receives life insurance proceeds upon the death of the insured. Is it A, executor? Or B, grantor? C, beneficiary? Or D, annuitant? The answer is C. The beneficiary is the person or entity designated to receive the death benefit proceeds from a life insurance policy. When the insured dies, it can be primary or contingent. Executor handles estate. Grantor creates trusts. Annuitant receives annuity payments. Because the beneficiary receives the payout, this is the term. Next question. An insured has both a personal auto policy and a non-owner policy. The other insurance clause in both policies states they are excess over any other collectible insurance. In a loss, how would coverage apply? Is it A, the policies would pay on a pro rata basis? Or B, the personal auto policy would always be primary? C, the non-owner policy would always be primary? Or D, they would cancel each other out, leaving no coverage? The answer is D. When both policies contain excess other insurance clauses, neither wants to pay first, so they may conflict and in some cases result in no coverage or require court resolution, but typically excess clauses cancel each other out, leaving the insured potentially uncovered unless one is deemed primary by law or intent. Pro rata shares proportionally. Personal auto is not always primary. Non-owner is not always primary. Because mutual excess clauses can negate coverage, this is how they often apply. Next question. Under a life insurance policy, the person who possesses the contractual rights, such as naming the beneficiary, is it A, insured? Or B, policy owner? C, annuitant? Or D, beneficiary? The answer is B. The policy owner is the person who owns the life insurance contract and holds the rights to name or change beneficiaries, borrow against cash value, surrender the policy, and make other decisions even if they are not the insured. The insured is the person whose life is covered. The annuitant receives annuity payments. The beneficiary receives proceeds. Because the policy owner controls the contract rights, this is correct. Next question. Concerning personal property, what does a scheduled personal property endorsement accomplish? Is it A, it removes the deductible for all personal property claims? Or B, it provides broader, often worldwide, coverage for specific high-value items like fine art? C, it reduces the premium for coverage C? Or D, it converts coverage from replacement cost to actual cash value? The answer is B. A scheduled personal property endorsement, also called a personal articles floater or inland marine endorsement, lists and covers specific high-value items like jewelry, fine art, or collectibles, often on an all-risk or open perils basis, with higher limits, broader territory, including worldwide, and sometimes no deductible. It does not remove deductibles for all property. It does not reduce premiums for general coverage C. It usually provides replacement cost or agreed value, not ACV. Because it gives enhanced protection for scheduled valuables, this is its accomplishment. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.